Gary is a San Diego financial solutions attorney, protecting people like you. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future. Now, here, you're live.
Hey, welcome to the Word on Wealth. I love it when you guys listen. This is super cool. We've got all kinds of things going on this week. We typically have Monday show we've got coming up. We got Rich Mathurin. He's coming up at the half-hour mark where we talk about taxes. We are in the tax season. This year, the tax season is stretched all the way out to October 16th. I had a secretary ask me this morning. She said, do people know about the tax deadline, the extension? And I explained it's not an extension. Literally, the April 15th deadline does not exist for 2023. It's not an extension. It's not the, usually you get an extension. You can get an extension to August. Well, this is literally the tax deadline is October 16th. It was just moved. No extension. There's no penalties. That's what it was. And the reason is because the federal government declared a bunch of counties in California as federal disaster areas with the availability of FEMA, Federal Emergency Management Association, FEMA help possible. I mean, including San Diego County. I don't know where in San Diego County we got like life-threatening flooding, but a lot of the counties in San Diego or California just said, okay, that's fine. We'll take it. There are 2 counties that didn't, and they're up north. It's going to be, I think it's Modoc and Redding counties, just way up there. And they just said, no, we don't have a disaster. This is just nature. So every other county in California, you can check. And if you're in a federal disaster area as a result of the flooding, then you do not have to file your federal or state tax returns for 2022. They are not due until October 16th, because October 15th is a Sunday. But don't wait that long. Don't do that to your tax pro. Get your information in. If the disaster affected you to where you can't get it together by 2015, which I have no idea how that would be for an individual, can't imagine, but just get it done. That way you can get your refunds, you can get your federal credits, you can make sure you take care of all of your stuff, because if you wait till October to file the return, then the next one's due in April 15th. So it's like, 6 months later. So just don't do it to yourself. Don't do it to your tax pro. Get your stuff done. Pretend like the deadline didn't really change. It's after April 15th now. So you hope, the deadline changed, but just get your stuff done. Get it done, get your refund. The IRS is sitting around waiting. They've got billions of dollars of unclaimed. And that's another thing, is if you haven't filed back tax returns for like years back, they're a little complicated. Most tax professionals don't want to touch them because they're kind of like, they're not clean. They typically, you got to know different rules. You got to know rules from older years. That's one of the things at GQ Law. That's one of the things we deal with a lot. We have a tax professional working for us, and Craig is awesome at putting together back years tax returns. And what we find out with a lot of people is you go do these back years tax returns and you can get your refunds. Now, if you wait too long, like this year, if you're already past April 15th, so you can't get a refund back more than 3 years. So we're 2023. Now we're looking 3 years back is April 2020, which would be your 2019 tax return. So that just passed. So if you didn't request your tax, if you didn't file your 2019 return requesting your refund, you only have 3 years to file. If you file more than 3 years late, you don't get a refund. So just remember that. Don't wait too long. You're going to be missing out on refunds. So get your returns filed, and those refunds go by the due date of the tax return, not the due date like this year's due date. So get your tax returns filed. It's just not worth waiting. You don't get your federal credits. You don't get your stimulus checks. There's a lot of problems if you don't do your tax returns. Get them done. You can call us at 855-500-TRUST, 855-500-TRUST. You can talk to Rich about that. We can get you set up with our tax professional, get your back taxes done. And then if you have a tax issue, you can deal with it. That's coming up. We can talk about that at the bottom of the hour. And Rich will take us right to the top of the hour talking about, different options that are available, offers and fun things like that. All right. So there's a couple of things. So this was an interesting case, actual case. that I had a while ago. This is okay to talk about. It's not a current client. I'm not breaking any confidentialities because I'm moving things around a little bit. So it's not an actual case. It's just exactly like an actual case. Okay. So Patty is mom. So Patty died and left money to her kids in special trusts for each child. What that did was the document that she put together said, when I died, I want a special trust set up for each of my children. And in each of those special trusts, there's going to be a certain amount of money deposited. Now, that's not hard to do with a living trust. It is totally possible. And so Patty died, and there was these special sub trusts that were set up. Those sub trusts are under the tax ID number of the original trust. So when Patty died, her Social Security number goes away, and the new trust is now irrevocable. That gets a tax ID number, tax identification number. So all the money, all the sub trusts for these kids are going to be held in these special sub trusts. Okay, because it's in the main trust, we have to be careful with tax issues and income issues. All right. So the question is, what can the kids do with the money? And the answer is you got to read the trust, because the trust document itself will indicate what that money can be used for. How soon can the kids take it out? How old do they have to be? And then what can they do with it if they're not of age? Okay, then there's other things like, can you close the trust? Are there tax returns due? That's the stuff I want to talk about in just a second. So right now, let's say we read the trust and it says the money stays in the trust for that child until they're age 35 and the kid's only like 20. So we know that stuff's going to be in the money's going to be in there for like 15 years.
Not a minute.
So we read through the trust to figure out exactly what the money is available to do. And a lot of times when you have a trust like that, the money that's available can be used for education, or if there are needs, like let's say you read through the trust and it says, it for education, broadly interpreted, to be like books, tuition, transportation, maybe moderate housing, something like that, that can be paid for. And that's under the discretion of the successor trustee, the one that's managing the trust in the meantime. That beneficiary goes to the successor trustee and says, hey, I can't get my money out of this trust until I'm 35, but I want an early draw, and I want it to be based on the rules of the trust, which says I can get money for education. So here's my tuition bill. Here's my housing bill. I'd like you to pay that. And that's what you do. You deal with the successor trustee on whether that stuff can be paid. Okay. Next, I want to talk about, can you close the trust? Is there a way to stop it, or do we have to keep it under the rules and the control of the successor trustee? 855-500-TRUST is my number. You can call me. Let's get your stuff in order. 855-500-TRUST. We'll be back in a sec.
You've got questions. We've got answers. This is the Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. GQLaw.com.
You're saving and investing for the future, and that's good. Have you ever stopped to think, where does my money actually go? This is faith-based investing with Anthony Wright.
Most Christians just don't understand that the money they save for retirement usually helps fund the abortion industry and other liberal anti-family causes. But did you know that with just a few minutes of your time, we can screen and clean your investments at no cost to you? It's absolutely complimentary. Just go to the website right now, download a free copy of my book, Faith-Based Investing. It's free as well. You deserve to know the truth as the investor. Then the choice is yours. You can keep doing what you're doing, or you can line up your investments and life savings with your beliefs. We are fiduciary investment advisors. You can feel good about investing with confidence. So learn more now. Go to BibleSafeInvesting.com or call me at 931-RETIRED. Your free book is waiting for you. Go to BibleSafeInvesting.com and be sure that you listen to Faith-Based Investing this weekend right here on Family Car.
Gary, our listeners are asking about trust disputes and whether or not they'll actually get the inheritance they're expecting.
I think that's a scary thing for most people, because they feel like, if I ask my successor trustee, hey, where's my inheritance? You kind of feel like, oh my gosh, I'm being like rude or whatever, inconsiderate. But I'm telling you, if time goes on, if it's been like 60 days, 90 days, 120 days, that's too long to have heard nothing. You're supposed to hear fairly soon, like within a couple of months after someone's passed, you should be hearing from that successor trustee. And if you're not, I think there's an issue we need to address. So it's not like we're going to go screaming in there and filing lawsuits. We kind of use gentle nudges like, hey, do you know what you're doing? Successor trustee, we kind of want to help you do your job, and we help beneficiaries kind of get things straightened out.
Call or click to request your free initial consultation. GQLaw.com, 855-500-TRUST, GQLaw.com.
Who will you trust with the biggest financial decision of your lifetime? If you're planning to buy or sell a home in San Diego County, do what I do and work with the true San Diego real estate experts. Ken Pecos and the Pecos Group helped me and my family. They can help you. This is Gary Quackenbush of The Word on Wealth. You hear Ken every week here on The Word on Wealth. He's our expert. He's got integrity, exceptional service, deep knowledge of the San Diego, Coronado, and South Bay regions. These are just some of the reasons that Ken Pecos has completed hundreds of transactions. He manages a powerful team of professionals at the Pecos Group. From single-family attached homes to luxury high-value waterfront properties to apartment buildings, Ken Pecos is ready to help you avoid problems and costly mistakes. Learn more online at kenpecos.com. That's Ken Pecos, Pecus.com. Or call 619-977-8419.
DRE number 010566969, brokered by eXp Realty.
Tell a friend about this broadcast outreach, The Word on Wealth, with Gary Quackenbush of GQ Law. Call or click to request your free initial consultation or to talk with a member of the team. Call Gary at 855-500-TRUST, GQLaw.com.
All right, everybody, welcome to The Word on Wealth. Happy Monday. We've got Rich Mathurin coming up at the half hour. We're going to be talking about I'm going to ask him some questions about an IRS Offer and Compromise. It's a really good program the IRS is extending under the Fresh Start Initiative. But in the meantime, I have a couple of things that I wanted to talk to you guys about. So the first thing is going to be, and we're talking about subtrusts. So in the example, Patty, mom, passed away and she left subtrusts for her kids. So like special trusts. And instead of the trust saying, when I die, all my money goes to my kids, it said, when I die, all my money goes to my kids, but it's to be held in a special trust for each child and controlled by the successor trustee. And it names the successor trustee who it's going to be. It was initially Patty's brother. And then if Patty's brother could no longer do it, then it's going to be, they had a friend and another family member. So she named several people because this trust might go on for a while. The rule was you had to be 35 to get all the money out of the trust. But in the meantime, that subtrust would be available to you to pay for education. So the question then is, what can you pull money out for? Like, what can you do with the money? And by reading the trust, we have to figure out what education means. Now, the trust, luckily, defined education as anything that was being pursued by that beneficiary that would further their education, that would be better for them, that would make their life basically better based on learning new things. So it wasn't just based on you have to go to college, you have to go to university, because sometimes that's too restrictive. And a kid will say, well, I never wanted to go to college. I don't need to. I mean, there's some kids that make a lot of money and they never set foot in college. Other kids want to get advanced degrees, masters, MBAs, doctorates. But you make it so that education is more liberally, construed. And that way the successor trustee has the ability to look at and say, you keep going to that welding class because you want to build another go-kart, and you want to build another dune buggy, and then you want to build a rack to store them on. It's like you're not doing anything you're not pursuing these for your own benefit. You're not pursuing these for your future benefit, for retirement or so no, I'm not going to give you that money. Now, the beneficiary, if they were refused payment by the successor trustee because they don't believe that money is being used to further benefit that beneficiary, is just using it for play money, then that beneficiary, if they want the money, they got to go to probate court and convince a judge that the trust intended that money would be used for the purpose that the beneficiary is proposing, like for travel or for fun or just, for fun classes or something. And a lot of times, the court's just going to say, no, that money was put away for your future benefit and not for your fun. So if you're going to use it for education, that's going to be, further your education, further your benefit to yourself and your retirement and all that, then let's do it. And if not, just don't come to the trustee and bug them for money saying, this is education, man. It's education. All right. So what about, can the trust be closed? Now, that'd be another thing, like in these subtrusts. Let's say one of the beneficiaries says, I don't like this subtrust thing because I have to keep talking to my uncle, who's the beneficiary or the trustee, and I don't like talking to him. I don't like asking him a question every time because he always questions me and he's not liberal with the money. He's not providing me enough to give me the education I need. I want to close this trust and get my money. Well, that's going to be based on the trust document itself. And in this case, because the special trusts were set up for the kids, and the whole idea is that mom wanted to control the money to make sure that her kids didn't get flaky and take all the money and decide they don't need to work anymore. It was totally, the trustee just said, no, you can't close this trust, because that would mean that you would take all the money out of the bank accounts, distribute it to the children, and then the trust is not necessary. So you close it. Well, to do that, if you want to force it, you're going to have to go to a judge. You're going to have to go to probate court and see whether the judge would allow that. Okay. Another consideration was the tax returns. Now, if the trust has a whole bunch of money in it and it has earnings, if that trust earns over $12,750, anything above that gets taxed at the highest personal income tax rate, which right now is 37.5%. And then you got federal or state taxes, which can go up to 12. So you're looking at, 49.5%. So basically half of it would go to taxes if it were taxed by the trust. So whoever is your successor trustee, we need to make sure that they know what they're doing. I don't want the successor trustee to prepare the returns themselves. I want the successor trustee to hire a tax consultant, to say what's the best way to do this. What happens is the trust files a return, a tax return, just like people do, or a company does, file a tax return and report the income and say, this is how much money it made. In fact, it made, $20,000 in earnings or $50,000 in earnings through the year. That's taxable at basically 50% of anything over $12,750. However, if you have an accountant, tax professional that's clever and knows what they're doing, they can pass that money on to the beneficiary. So that money that the beneficiary is receiving, instead of saying that income is trust income, you say that it's income split out between the beneficiaries. So if there's only one beneficiary, that's fine. So let's say we made the $50,000 that we were just talking about. That $50,000 then goes on to the beneficiary's tax return. And if it increases the amount of taxes they would owe, which certainly it would, the trust writes a check for the extra tax. So it's not going to cost anything for the beneficiary to have earnings in this trust. It's just going to be passed along to the beneficiary so that it can be recognized and dealt with on the beneficiary's tax return and keep the tax rate lower. It's likely that the beneficiary is going to have a lower than maximum tax bracket, unless the beneficiary is earning, $350,000 or married couple $400 and something thousand a year. Unless they're earning that kind of money, they're not going to be in the upper tax bracket. So it makes sense to pass it along to them, and then the trust will reimburse them for the taxes that need to be paid. So my point on that is get help. Don't try to do the trust alone. Don't try to get the tax returns done alone. And see, the thing is, if you're a successor trustee, even if you know how to do taxes because you've done your own tax returns for the last 40 years, it doesn't matter. Okay. You've never done a trust tax return for this trust. And if you did last year, shame on you. Get a professional. You're required under California law to delegate duties to people that are professionals because they have insurance. If they mess up, covered by insurance. If you mess up, it's potentially covered by your inheritance. But if you don't have an inheritance from the person that died because you're their brother helping him as you being a successor trustee, then if there's any consequences to any of this stuff, then you could be charged. So you don't want to do anything yourself, because if you do it wrong, you could be surcharged as the trustee. I mean, you're going to get paid to be the trustee, but you could lose all of it if you mess up. So you want to get professionals. You want to make it so it's their problem, not yours, and you're the one that's quarterbacking it. That's what I recommend. Okay. The resolution of this case we're talking about, it was literally, we ended up talking to our tax pro, and we started calculating out what would be the best way to hold this money. And we ended up moving the money to like an individual trust for each kid. We made it so that the mom's trust was no longer the main trust holding all the kids' money. We actually set up sub-trust, like actual sub-trust for each of the kids. And that way it's managed in 4 separate sub-trusts. And if there's any tax consequences, that sub-trust will pass on to the beneficiary. But it was a better way to go, I think, because we ended up, each beneficiary had their own sub-trust. They could hire a different tax professional if they wanted, or we can manage it all together. But it wasn't that much more expensive to do sub-trust. It just made it much more clear. And then the beneficiaries could see what's happening to their money, how it was being paid out, for what reason it was being restricted or allowed, and whether it was getting earnings. So that was kind of a cool way to do it. Okay. I have a big question. Is it possible to be prepared to die? The reason I'm asking that is because I don't know that it's really possible. And that's coming from me. Is it really possible to be prepared? So if the worst case scenario is, you're going to die in 2 weeks, can you do everything you need to do in the next 2 weeks so that you're prepared to die? And I think the answer is no. Even if you're super prepared, you've been preparing for years and years and everything's super organized, I would venture to guess if you were told, hey, you're going to die in 2 weeks, you're going to be working for the next 2 weeks to try to figure out what things you need to do to straighten everything out and make it perfect. I'm not a huge fan of doing that. I'm a huge fan of making sure that the big stuff will be taken care of. But if it's not going to go into probate because it's worth less than a certain amount of money, I always want to do the calculation and say, hey, it's not going to go through probate. It's not a big deal. We don't have to do that. We should do this. This is probably the most important. So to make it so that only certain things need to be done before someone passes away. But is it possible to actually be prepared for your death from a financial standpoint? And I don't think it is possible to be completely prepared, because you don't know when it's going to happen. So you don't know exactly. However, we know it's going to happen. 100% chance of dying before you leave this life. 100% chance. So those are good odds. That means we should get ready. Now, it doesn't matter if you're 30 or 110, you need an estate plan. That's the bottom line. You don't know whether, how long you're going to be around. Is it going to be through the weekend? Be next week? Going to be today? Don't know. But you have people that you're taking care of, people that you're watching over, people that you have a stewardship over. And I think they deserve to have you prepared, and you deserve to have that kind of peace of mind, knowing that you're okay. So what we're doing is, in my firm, GQ Law, is we're doing estate plans, and we do a lot of them. And we feel very strongly that we are helping you guys be prepared so that, if you pass away, in the next couple of years, everything's going to be organized. We're trying to make it so that the plans that we have will last for, decades. But we talk about that when you come in and talk to us about setting up a trust. So if you want to talk about your estate plan, how it works, what it costs, how long it takes, How long it takes? It's like less than 2 weeks. We're pretty fast.
Got a minute.
And then how do you work it out? And we are the ones we'll talk you through the whole thing, tell you how it all works and all that kind of thing. So what we usually do is you call us at 855-500-TRUST. So 855-500-TRUST. And that'll get you through to where you get an appointment. You can come and see me. Now, when we talk about it, I'm going to be asking you, what do you own? Do you own a house? Do you own a condo, timeshare? Do you own any vacant lots? What are your retirement account situation? We'll talk about beneficiaries to make sure your beneficiaries are set up right, make sure things are titled right. You want it to be clean as possible so that when the time comes, you'll be all ready financially and paperwork wise, and you don't have to worry about it. And that's going to be a good feeling. All right, 855-500-TRUST. Coming up next, we've got Rich Mathurin of GQ Law. He's a tax attorney, deals with tax problem solving day in and day out. We have him cornered to answer your questions. So we're going to open up lines when we get back. It's going to be 888-344-1170, and we'll be back in a minute.
You don't need everything to know it. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush.
You don't everything.
Jeez.
This is Gary.
That's because I was coughing.
Administration
Blew up
in
the surface.
Call Gary and the team.
Cough on Gary now. Don't spread your
800
elsewhere.
Trust. Team at GQ Law, 855-500-TRUST. Or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's gqlaw.com. 855-500-TRUST.
You're live.
Right. Welcome to Word on Wealth. We're in the second half of our show, and we've got today's Monday. So that means we've got Rich Mathurin from GQ Law with us. Hey, Rich, how you doing today?
Great, Gary. Good to be here again.
You know, you just keep coming back week after week, and that's just fantastic. We like the consistency with people because, then people listen.
Well, the IRS and the FTB don't go away. So,
gosh, I know. For a while there in the pandemic, we went, oh, wait a minute, maybe they're going away. I mean, talk about that, because I think a lot of people think, well, they just went away. They're not collecting any money.
The FTB has been operating throughout the pandemic, been very aggressive with collections. The IRS was dormant, I would say, for a year or two, but I have started to see their fangs starting to show again. I have been getting calls from local revenue officers on different clients recently, so they're picking back up activity. Notices are starting to be sent and stuff. So please do deal with your IRS problems also.
Yeah, it's not like it. I mean, it doesn't go away, even if they were like not collecting for a while, whatever. And even though you hear the news where it says the IRS is just, it's chaos. They're so disorganized. They're just chaos. Well, welcome to, what is it, Q4 of the pandemic. We're like in the fourth quarter of the pandemic. I mean, that's kind of like, from a football metaphor, we're in the fourth quarter. That doesn't mean the game's over. They can pull it together, and the IRS typically does. They collect money for the government, and the government needs money. So believe me, they're not just going to go away and say, oh, whatever, we don't need tax money, because then people would just kind of not pay their taxes.
Yeah, they did do one thing nice for taxpayers. I think we've mentioned it before, that they've extended the filing deadline to October 16th for all tax filers for their 1040s. Plus, the state has reciprocated and also agreed to that date. So you do have extra time, and it's good. You don't have to pay interest on that money. If you owe taxes from April 15th to October 16th, you wouldn't have to pay taxes on that money, but do get your returns filed. We've talked about a lot about, not filing, and how these substitute for returns, or these notice of proposed assessments that the two taxing authorities issue if you don't file your own tax return.
Yeah. And the thing I was mentioning earlier on the show was like, if just because the IRS isn't kind of pressing you as hard as they would have, 3 or 4 years ago, if you're entitled to a refund, if you wait too long, you won't get your refund. If you file more than 4 years late, the IRS just says, okay, we owe you a refund. No, we don't, because you filed too late. So it's not like you can just sit back and say, oh, I'll catch up someday. You can miss refunds. So I had, this was, I don't know if I've ever told you this one, Rich, but this is back when I had an office in Denver, Colorado. And I remember a guy came in. The scariest thing for a tax professional is when somebody comes in right before the tax deadline, and it was like 3 years, so he had returns that were like more than, they were like a whole bunch of returns. Okay. So he came in right before the April 15th deadline. This is years ago. And he wanted to get, he came in right after the April 15th deadline. He says, okay, I got a bunch of tax returns. I need you to get these filed. So I've got 4 years of back tax returns. So it was the current year, which now is late because we were past the April 15th, but he came in late. So it wasn't like it would have been my fault if he came in the day before. So it was nice that he came in, nice. But so we filed an extension on the current year. And then we had returns for the next year, the next year, and the next year. So we ended up putting together a tax return for all the years. And I remember him coming in and talking about the tax returns. And I said, so because you came in after April 15th, that means you missed the refund, which was, you can only go back 3 years on your refund. So you missed the refund on this thing by whatever it is, like 2 weeks. And the refund was $27,000. It was like, oh my gosh. If he had come in like April 1st and we went, okay, my gosh, we can't get your work done. We're really super, busy. We are really, so we're just going to put an extension. Well, the extension, they don't care about extensions if you're trying to get an old tax return filed. So the thing that we were finding out is like, if you owe back taxes, to get to really the ones you need to care about is that your current year, you want to get that in time or file an extension, or you're going to have late filing, late payment penalties. And then you want to go 3 years back. So the one 3 years ago, you want to make sure you file before April 15th, or you're going to miss potentially your refund. And then the state of California is 4 years, 4 years. So you have to file the 4th year back to make sure you get your California. To do a California, you have to file federal. So basically, if you haven't filed in the last 4 years, you got to file this year, 3 years back, and 4 years back, and do it right before the April 15th deadline, or you're just going to miss it. And I don't know how many letters I've gotten from the IRS where it just says, you filed it too late, you don't get a refund, So,
I can't imagine people giving up free money. I wouldn't miss it if I was owed money by the IRS. I'd file it on April 15th at 12:01 a.m.
Right.
12:01 a.m.
Yeah, I mean, exactly. Or January, as soon as you get your W-2 or whatever. But now, and you were talking about that before, that, some people, they go, oh, I'm not going to file my returns. The IRS sent me, I didn't even file my returns for the last 5 years. And I got this big old tax bill. I just don't want to face it. The IRS is coming after me. So forget it. I won't file. But you told a story a while ago that somebody had come in and owed a bunch of money for a bunch of different years. And then the result of getting the tax returns done kind of flipped it over on its head.
Yeah, I've seen it a lot of times where we've had our tax preparer work on missing returns from the past, or the substitute for returns where he's fixed them. And, the client went from owing $60,000 to getting a refund for one particular year. It really, those substitute for returns are really insidious things that I think that they almost always are going to create a much higher tax balance than you would actually owe if you did it and hired a professional to do it and got all the deductions, took the filing status that you were entitled to, get the dependents, all that kind of stuff. You don't get any of that if they file their return on your own by themselves for you. So please do file your returns.
So it's like because the IRS, I mean, it's right. It's written right in the Internal Revenue Code. If you have not filed a tax return for a tax year where it's required, then it says the secretary, referring to the Internal Revenue Service, that they have the ability to go and use whatever means they have to plug in your income, whether they're estimating the income or whether they used a 1099 or W-2 or whatever. They can use those documents, put together a return. Accuracy is irrelevant because they just use what information they have, and they can assess a tax and start coming after you. And the thing that I learned, which is I thought was really weird. I mean, a lot of people will say, well, the IRS, they didn't send notices to my home address. And so we ask them like, well, did you move in the last 4 years since you filed your returns? Well, yeah, I've moved twice, but they're sending, I don't know where they're sending their mail. Well, they're sending the mail like back to your old address. I mean, does the IRS have any legal requirement to follow you around and check your new address before they send a letter?
No, you would have to file a change of address or file a tax return with your updated address. They have no legal obligation to try to find you. I mean, if they're going to send the notices to the last address that they have on file for you, and unless they hear otherwise, that's your legal address to them, and you've got notice of your tax balances.
Yeah, and that's what they call due process. It's different with the IRS. Now, that was a thing. So what we're doing, you're talking to Rich Mathurin. He's from GQ Law. If you want to ask Rich a tax question, you can call today on the show, 888-344-1170. Or if you want to talk about your tax situation, or while you're at it, talk about your estate planning, you can call Rich or me at 855-500-TRUST. Now, the one thing that we had talked about this before too, Rich, is the IRS does have what I refer to as deals. They have ways of resolving things. So, if somebody comes in and gets their tax returns put together and they still owe way more money than they can afford to pay, we want to get into like, what should they do? And specifically, we've been hearing a lot about offers and compromise. It's advertised really heavily for obvious reasons, but then you've had some terrific success lately with offers. I
had a great a client that's very nice lady we just got an acceptance the other day for her, and I was ecstatic about it. She's gone through a lot, and she's a really nice lady, a hardworking, owns her own business, and got caught up into some things, but we did get an accepted offer for her. I'd like to tell you a little bit more about it.
Yeah, that's terrific. Yeah, the Offer and Compromise program works great. It's got to be done right. If it's done wrong, that might, it might foreclose you from trying it again, but you got to get things right. You got to hire somebody who's willing to do the work to get it right. This is The Word on Wealth with Gary Quackenbush and Rich Mathurin of GQ Law. And when we come up next, we're going to talk a little bit more about offers and compromise. Super cool program from the IRS coming up right here on The Word on Wealth.
You've got questions. We've got answers. This is The Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. GQlaw.com.
Gary,
How do you and your team help our listeners avoid probate?
Well, first of all, probate is a process that involves attorneys, judges, and sometimes contesting parties. And so we try to avoid probate at pretty much all costs. The way we do that is setting up living trusts, setting up properly documented wills, putting the property like houses, cars, bank accounts in that trust so that it avoids probate. Probate is only necessary if the estate plan isn't set up quite right. So we help them get it set up right. And mainly that's done through a properly created living trust.
Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs, call or click to request your free initial consultation. That's gqlaw.com, 855-500-TRUST.
Who will you trust with the biggest financial decision of your lifetime? If you're planning to buy or sell a home in San Diego County, do what I do and work with the true San Diego real estate experts. Ken Pecos and the Pecos Group helped me and my family. They can help you. This is Gary Quackenbush of The Word on Wealth. You hear Ken every week here on The Word on Wealth. He's our expert. He's got integrity, exceptional service, deep knowledge of the San Diego, Coronado, and South Bay regions. These are just some of the reasons that Ken Pecos has completed hundreds of transactions. He manages a powerful team of professionals at the Pecos Group. From single-family attached homes to luxury high-value waterfront properties to apartment buildings, Ken Pecos is ready to help you avoid problems and costly mistakes. Learn more online at kenpecos.com. That's Ken Pecos, Pecus.com, or call 619-977-8419.
DRE number 010566969, brokered by eXp Realty.
Tell a friend about this broadcast outreach, The Word on Wealth, with Gary Quackenbush of GQ Law. Call or click to request your free initial consultation or to talk with a member of the team. Call Gary at 855-500-TRUST, gqlaw.com.
All right. Welcome back to The Word on Wealth. If you want to get a hold of Rich Mathurin to talk about your tax situation, the number is 855-500-TRUST. And you can set an appointment to talk to him and see if there's something that he can do to work on a deal with the IRS or something. And we're going to continue talking about that. Rich, before we took our first break, you were mentioning that, I brought it up that you've had some real success lately with these offers and compromise. I wanted you to talk to our listeners about that and kind of explain, what's that about? Who does that really help? And then tell us a couple of your success stories.
Yeah, the offer and compromise program. I want to, I think we've talked about this before, but please be careful about these ads that you hear on television or billboards or on the radio about, settling your tax balances for pennies on the dollar. And then they just want to take your money and they don't even do any analysis. The offer and compromise is a very specific program of the IRS. And if you can pay for your balance in full through an installment agreement, the IRS is going to push you into that. Or if you have assets, and that would include home equity, retirement accounts, bank accounts that could pay for your balance in full, the IRS will not, they consider an offer, but they want full, they'll say,
Yeah.
give us your full payment.
100 pennies on a dollar, right?
So please, be careful about these advertisements where people just want to take your money and submit an application that has no chance of success. Please get to somebody reputable that will do the analysis to make sure that you do qualify. But like I've said, it's a great program. If you do qualify, if your income and assets show that you cannot full pay your balance before each of them expires under the statute of limitations, that's 10 years from the date of assessment we've talked about previously, then an offer in compromise is something that the IRS will consider. They look at basically 80% of the equity in your assets. So it's not good for people with a lot of home equity, high retirement accounts, and then plus your net income times 12. So if you earn a high salary and you don't have a lot of dependents, it may not be a good program for you. But if you do qualify, we've had some where we've gotten millions of dollars of discharge for like a couple of thousand. A lady like I mentioned recently, she had, I think she owed over between 100 and 200,000, and we settled for a few $1,000. So that was a huge savings. It's really a game changer, a life changer, and if you can get one of these accepted. But again, please make sure that you qualify and that you're not just paying somebody to submit an application that has no chance of success.
I think these success stories, I mean, this is real stuff. These are real people. It really happens. The program is based on the IRS's Fresh Start initiative that came out in 2014. And the theory behind the whole thing is the IRS figures if people can get into compliance where they filed each tax year, they kind of admit that they owe on whatever years, then that's kind of the first step. Then if this program, this offer program, if it would be something that would benefit that taxpayer to get them a fresh start, kind of a start over, and that deal would really help them, that's what the IRS is looking for. They're not looking for somebody that could pay and they just don't want to. I just don't want to pay my taxes. I just want to get rid of penalties and interest. Well, you can get rid of penalties, in a lot of penalties, not always all, but I mean, you can talk to Rich about that too. Just call 855-500-TRUST and talk to Rich about penalty abatement. That's something that comes up. But as far as the IRS, they want you in compliance. And that's the thing. So if you're okay with that and saying, okay, I fell behind, I'm going to get caught up, I'm going to move forward, that's really the only way to go. We're not talking about like rebelling against the IRS and saying taxes are unconstitutional. You shouldn't have to pay taxes. I'm going to untax myself. I'm going to drop my social security number. I mean, that stuff, it's just like, don't do that. And people try that. They've been trying it. So, I mean, I've been doing this for 30 plus years, and that's just nothing new. It's like, you guys, it hasn't worked 30 years ago. It doesn't work now. Deal with the system like it is. There's an offer and compromise program. There's this Fresh Start initiative, and get somebody like Rich that knows what they're doing. So on the offer, so it's like, so you put together this application called the offer and compromise. There's a bunch of other things with it. But if the IRS finally says, okay, we will accept X amount of money, do they have to like write a check, or how does that work? How do they pay?
20, unless you can qualify for a low income payer and you don't have to pay, but normally 20% of the offer has to be submitted with the application.
Okay.
Unless, I think if you make less than, I want to say $40,000, you can get that 20% waived. And then after you get acceptance, the remaining 80% balance would have to be paid over 5 months. You can pay $1, and then the balance on the 5th month, or, you can split it up into 5 equal payments,
Okay.
whatever you choose. But I think you can even not pay for the first 4 months and then pay the final balance. I did have one client, husband and wife, that did take that route, and they paid everything in the last month. But, so you have to budget for that. It's 20% down plus a $205 application fee. And then once you get an acceptance, also that's where I think I really earn my money is sometimes, the IRS will come back and say, yeah, we might accept, we offered 10,000, and then the IRS comes back and say, we really think it should be 20,000. And then I look at the numbers and look at their analysis, and I usually can, we had a recent client that got accepted last summer, and I think we had offered like 9, the IRS had come back at like 18. And then through my analysis, I think we settled on 12,000. So it was a really good deal. So, but again, do get somebody that's competent, that understands the program, and isn't just going to submit the application and take your money. So,
yeah, that's true. And the attractive thing I think for people that, some of these companies are just, I don't know, they're not, I don't want to go too hard on them, but if somebody's going to just take your money and file an offer, anybody can send in the form that says offer and compromise, and the IRS will stop collection just because that's their process. But if that's all you're getting by submitting a 656, the form, you're just getting a collection delay, then all you're doing is compounding the problem, because then the IRS, if they reject the offer because it's just garbage, it didn't comply with any of the rules, and there's no way it would have worked, they reject the offer, they keep the deposit, they keep the filing fee that you paid. And then if you submit again with the same facts, they just say, sorry, those are the same facts. Nothing has changed, so no offer. You want to get it done right. And the thing that works out, and I like to see with Rich, what he does with clients, is that we do the analysis to know, is this going to work or not? Does it meet the criteria? Have we massaged the numbers enough? Have we worked with the numbers enough? Have we worked with a client long enough to make sure that the things will fit in all the right boxes, and where we can negotiate, we negotiate. So, but the offer, I mean, it's nice when it happens and people get an offer accepted. It just like saves their rear end.
Yes, the lady that we talked about has had some issues from the pandemic and prior years from a small business, and it's life changing to her to be able to run her business going forward and get out from under this. This has sort of been hanging over her head. I think a lot of it is small business people that get into problems with trust fund recovery penalties or back business taxes they just couldn't afford during the pandemic. One other thing that I will mention about the offer program is if you have a substitute for return balance, they are not dischargeable in a bankruptcy, but you can include them in an offer. So if, let's say you had a substitute for return back in 2015, you can't fix it because you don't have records and stuff like that. You can say the IRS, I'll accept that, but I want to include that balance in my offer. And I did that with that client that we settled for 12,000. He had some SFRs, and we were able to include those in the offer and got an acceptance. And that was a huge tax savings for him.
And it seems like now's the time to do it. I mean, the IRS, they are ramping up collections. They're trying to find more people that are willing to work for them to do their collections and stuff. But it's like, now's the time. If you have a tax situation, you haven't filed in a while, it's not like you have to file the returns and then they get instantaneously filed. I mean, our method that we really like is like, if you're missing 4 or 5 returns, let's get the returns ready, make sure we're not missing any deadlines, but get the returns ready and then take a look at them and then come up with a game plan before you submit them. If you're going to qualify for an offer, then that's going to be the solution. And then it's going to be file the returns, wait for the assessments, and move forward. But it's all about, don't stick your head in the sand. Because if you do, your rear end is still in the air and the line is still charging. So it doesn't matter if you try to bury the problem. Don't think that just because the IRS is behind in their mail trucks, and which is all true, and that it's chaotic at the IRS. I mean, you can ask anybody and it's all over the news. Oh, it's chaos. But believe Rich and I, when we say the IRS, there's only 2 departments in the federal government that are net positive revenue. In other words, that make any money. One is the DEA, Drug Enforcement Agency, because they seize, vehicles from people that have drug crimes. That's positive net income. Okay. The only other department that supports our government's need for $14 trillion of income every year is the Internal Revenue Service. So don't believe that the IRS is just the government's going to say, well, things are chaotic. I guess we won't collect taxes this year. Really? They're going to collect the taxes. But now's the time, get in here. Let's get your tax problem solved, get your back taxes done before it gets too heated up, because the IRS is going to collect the money. That's the bottom line. That's how they do it. They've got to collect all this money to keep the government going, right? So call us 855-500-TRUST. Rich, 30 seconds. Any last minute advice for these?
I will say, these programs are really good. Installment agreement, offer and compromise, bankruptcy, currently not collectible. Something will fit for you, but you please come and see me, and I will give you, your best option, and I will lay it out it probably isn't going to be pain free, but it's going to be a lot less than if you get a surprise levy or a surprise garnishment from the IRS or the franchise tax board. So please do try to deal with your issues.
All right. Well said, Rich. Thank you very much for being on again today. It's 855-500-TRUST, guys. 855-500-TRUST. Call Rich, let him fix your tax problems, and we'll be back tomorrow right here on The Word on Wealth. See you then.
Tell a friend about the Word on Wealth, featured since 1995. With financial solutions attorney Gary Quackenbush, an expert in estate planning, wills and trusts, and tax problem solving. Gary is past president of the California Society of Tax Consultants. Reach out to us. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future. On the Word on Wealth is for general information purposes only. This program discusses general financial and legal topics. Seek legal advice from a competent lawyer for your individual legal needs. The